In the constantly changing world of fundability, the big question is this: how are entrepreneurs and real estate investors like us, ones who want to grow our businesses and who are tired of paying for really expensive alternative lending, how do we tap into the most inexpensive money available and do it without the hassle of typical borrowing? That is the question, and this podcast will give you the answers. Welcome to the Get Fundable podcast with your host, Merrill Chandler.
Welcome, everybody. This is Merrill Chandler, your host of the Get Fundable podcast. And as is everything in the world of fundability, we're going to be updating some previous podcasts from a month last year even. We've got some great insight, some new ways to help you with your fundability. And we're going to be talking about the old paradigm and how it no longer, business funding and what people still believe, and it's kicking them in the teeth every single time. So when we get back, we're going to dive right into, and I've got a great presentation that I'm going to be sharing with you. And this is going to be one of those guys that you'll, if you can, go to getfundablepodcast.com and watch the video. Otherwise, let's get started. All right, welcome back, everybody. This is Merrill Chandler, your host. I was going to say your guest. I'm happy to be a guest on my own podcast. Merrill, how you doing today? I'm doing great, Merrill. This is awesome. Let's get started. Today, we're talking about kind of the old paradigm for business credit. Some people even get away with trying to say corporate credit. We're going to disabuse you of all of those myths, and we're going to be updating a podcast that we'd done literally a year and a half ago. So in this particular instance, we're talking about the old paradigm for business funding, and we're going to compare it with the new paradigm. And I've got, and like I said before the intro, if you can, this is one you want to watch at getfundablepodcast.com. You want to see the visuals. But to those of you who are working out right now, those of you who are on a walk right now, I'm going to be as detailed as I possibly can so that we can all take home the best possible results for our time together here in this podcast. So, what is the old paradigm, right? Well, let's start there. First of all, it's something happened in 2008. Now, most individuals who sell a business credit, right? Business credit salespeople act like nothing happened in 2008. And something radically, there's a massive departure from the old way of getting businesses credit. So let me tell you a personal story that you may have heard. If you attended the boot camp, you may have heard this, but when in 2007, during the run-up, right? I mean, everything, they were financing everything. Cars, you could get 125% on the value of vehicles, right? Mortgages, if you could fog a mirror, they were willing to give you a mortgage. Well, the same was true for business credit. And business credit, like I had my company Echelon back in the day still, and in one day, at two different branches of Chase, I filed a single page stated income application asking for $100,000. Stated income, pull my credit, no harm, no foul. Two different branches, two different applications, two different requests for $100,000 each. I was approved within 6 hours of both of them. I had walked out of that day, put my head on my pillow at literally $200,000 richer in credit lines. Non-personally guaranteed and non-stated income, right? Things have changed since then. The exact same fall that was caused by the mortgage crisis. Remember, they were lending to anybody who just fill out a piece of paper, right? An application. Well, now you actually have to meet the certain underwriting criteria. You have to have that. It has to be full doc across the board to be able to get a mortgage. Well, the same thing happened, or similar things happened with regards to business credit. Now, I'm going to pull back just for a second and let's get some definitions down. First of all, there are groups out there who sell business credit, and the business credit they sell you is, quote, credit you can use for your business. That means they're willing to give you a personal credit card that reports to your personal profile. And every time you use it for business, it ruins your personal profile because your balances go up, your utilization goes up, your score goes down, your fundability goes down. Okay? So they're using language to deceive you because they're relying on your ignorance. They're relying on the fact that you don't know the rules of this game, so they call it business credit. Now, here's another thing. Some of them they'll say, oh, we'll get you a credit line for $20,000. But they will then show you on their website that it says credit line equals 20,000, but up in the top left, it'll say Bank of America business credit card, right? It's a credit card, not a credit line, even though the bank uses the term, instead of credit limit, they call it a credit line. But now they're in the business of getting you credit lines. And so they completely blur the lines to deceive you, because everybody out there, small business owners, entrepreneurs, real estate investors, everybody's looking for business credit. And most of you are looking for business credit lines, true lines. Write a check, do a deal. Not a convenience check, which is another thing these guys do. They'll say you can write a check, but it's a convenience check. And that convenience check is more like a cash advance check, right? It's not a true credit line, like a business credit instrument called a credit line by banks and financial institutions. So things have changed since 2008, just like mortgages require tons of documentation. On the business credit side, they stopped using references to your business credit. Literally, cut it out. The Dun & Bradstreet Paydex score that was valuable before 2008 is no longer a valuable measure of your business fundability. Why? Because the old paradigm would use credit that was acquired for your business, like vendor credit, retail credit, what we on the personal side, what we call tier 4 40% junk cards. Dun & Bradstreet records those. And so you would get a Dun & Bradstreet score, and then Dun & Bradstreet, it would offer you more credit. Since 2008, not a single bank that uses automatic underwriting criteria, part of that automatic underwriting criteria is not your Paydex score. They use your personal profile to establish your credit worthiness, to your fundability. They're using your personal. That all started with the new algorithms that FICO is coming out with, and that the lenders started underwriting their business credit instruments. It all started on, as we've talked about before, David, in the interview I had on previous podcasts last fall, David Smith of FICO said that 80% of a funding decision, a business lender's decision to lend you a credit line or a business loan, 80% of that decision was based on your personal profile, the personal profile of the principal of the business, right? The other 20% is based on the data points that match your personal profile. So if my name is Merrill R. Chandler, my PBID, my personal borrower identity, if it's Merrill R. Chandler over here, but I have Merrill Chandler or Merrill Ray Chandler, that is close, but it's not a perfect match. They're looking at the business. Who owns the business? And if the who owns the business is different than who is who the principal is, then you're going to get yellow flags, red flags, or denials. So The whole point of the old paradigm, new paradigm, is that in the old paradigm, there was they are using terms today that were only valid pre-2008. Now, the other thing you got to watch out for, guys, is the use of the word corporate credit. Just so you know, in technical usage by all the banks and institutions, corporate credit is usually for institutions that are $10 million value or higher, $10 million in revenue. It's where you have a Standard & Poor's credit rating as a corporation. Those corporations are not backstopped by the principals or the CEO or the chairman of the board or the board of directors. That's corporate credit. But because and it's not your fault, it was none of our fault when we didn't know, but because they're trying to, once again, they're trying to make it sound cool. Yeah, we can get you corporate credit. No, they're not getting you corporate credit, because corporate credit is credit lines like $100,000, million, $10 million credit lines to use with your corporation that is worth $10 to $50 million or more. That's corporate credit. Anybody, if you hear somebody say, we'll get you corporate credit at 0% interest, they're selling you credit cards, because only credit cards offer 0% credit, 0% as a promo, right? Credit lines, there's not a credit line in the universe that says, yeah, we'll let you write a check and do a deal interest-free. So if it says interest-free or 0%, take it home to the bank, guys, that they're talking about 0% credit cards. Most of them report on your personal profile. All right, so that's our stage. We're going to start out. That's our stage here. We want now to examine how that old paradigm turned into what is now, what makes you fundable now as a business. So I'm going to share my screen, and let's go to number 1. So the old paradigm is all about why business lenders won't lend to you today. Yes, it worked. It worked for me. I got 200 grand in unsecured stated income credit lines, true credit lines from Chase back in 2007. That is not going, that you have to do it differently now. Differently. They're still available, but now we're going to talk about the old way and the new way. So I ask you guys on a regular basis, are you a business owner? Do you classify yourself as a business owner? Do you ever think of yourself as self-employed? And you wouldn't believe that 40% of people who come to my boot camp literally have self-employed as their employer, right? And we're going to talk about how that isn't serving your cause when you're going to for business borrowing in today's environment. And then, do you consider yourself an employed professional? Well, if you go to any application right now, there's a drop down like, who are you? Tell us about who you are. And it's going to be employed, unemployed, self-employed, student, disabled, retired, military. And you kind of get to pick which one. Well, I ask you, which of all of those is the most fundable? Which is the most dependable when it comes to income? Unemployed, employed, or self-employed? In my boot camp, the answer is obvious. Everybody shouts out that employed is the most dependable. But you may come back and say, well, hold it. I am employed by my own company. That's okay. As long as you are the principal of the company, we want to separate you from being the owner as being the runner, the manager of the company, right? You are the principal of the company. It is business owners. are not a safe and reliable bet for business lenders. The business owner creates degrees of uncertainty. There's the very words that, say that there are variables that need to be investigated. Well, tell me about your business. Tell me about your business, right? So the other thing is, a self-employed is also not safe and reliable. The term self-employed even creates degrees of uncertainty, right? There are variables that need to be discussed. Tell me about your business, because you're focusing everything over on your business. In today's environment, an employed professional is what is safe and reliable. Think of it this way. If you are the employed professional, the language itself, besides all the facts, the language itself says that my business is sufficiently funded, is doing well enough that I'm employed by it. Now, you can have a W-2, you 1099, you can take disbursements as an owner, but when you're an employed professional, when you are the principal, not the owner, it's not semantics, guys. If you are the principal of the business, then you are far more fundable than if you are the owner of the business, right? So lenders are looking in borrowers. Lenders are looking for borrowers who create conditions of trust, and someone who is going to treat their money, their funds, with deference and respect, right? But the face of fundability is, once upon a time, there was the legend of non-personal guarantees, and before 2008, that $200,000 that I got from Chase was not personally guaranteed. It was solely on my business. Now, we'll use the example of Wells Fargo, which I do have. If I have credit lines at Wells Fargo, I'm on the line for it. Non-personally guaranteed is for cash lines. And this is where I want to separate it out, guys. If a cash line is something you can use same as cash. It's not a Staples credit card that you can only shop at Staples. It's not a Home Depot where you can only shop at Home Depot. Those are not cash lines, cash cards. There are numerous type. You can get gas cards that are not personally guaranteed. We'll get to it in a second. I'll show you what I mean by all that. All right. So there is, for true cash lines, there is no such thing as not being on the line for it, on the hook. Where there's not a personal guarantee. So let's look at the personal guarantee comes with a credit card, credit line, charge cards, installment loans for business credit. Non-PG are, like we've discussed, retail cards, gas cards. Get a U-line. They're not going to put you on the hook for a U-line account for ordering office supplies, FedEx, Staples. You're not on the line for those. Vendor credit is your internet, phone service, web hosting. You're not on the line for those. But the individuals who sell this type of, that say we're going to get you non-personally guaranteed credit lines, are actually talking about what's below that red line. So that's the thing that we need to understand most. Now, let's go to what the new paradigm is. So the old paradigm doesn't exist anymore. That's why it's the old paradigm. You cannot get a business line of credit, a business loan, without also being on the hook for it. Okay, those left in 2008, and now 2008 is literally 12 years ago, and yet people today untoward businesses today are still selling corporate credit that doesn't exist for small businesses, doesn't exist. And they're selling they're selling the business credit lines, which and are actually a non-PG credit, non-PG, non-personal guaranteed credit. But what they're referring to is a Staples account, a U-line, Federal Express, or gas cards, or the like. All right. So let's take a look at the old paradigm is not fundable, but let's understand why it's not fundable. So let's say you have 6A, you're just an enterprising soul. And I'm going to pick these because it represents the vast majority of the folks that go to my boot camps or who are listening to me right now. You sitting right there, you jogging, you at the gym who are listening. Let's say you have a note buying business, you have a buy and hold business for your rentals, you have a fix and flip, right? Let's say you even have a franchise and you do private lending to other real estate investors, right? In the old paradigm, we think that we have to go get money. We got to go get a loan for our note business. We got to go get a loan for our buy and hold business. We got to get a loan. We got to get money individually for each one of the businesses that we have. The thing is lenders don't like lending to small businesses. They don't. And I've told the story a dozen times, but it bears repeating now. At FICO World 2019, there was a panel of 5 or 6 lender representatives, right? The heads of underwriting for these 5 or 6 lenders. And they were joking because remember, they think only lenders are sitting in the audience. Me, I'm representing borrowers. They don't know me. They don't know that I'm there. But they were making jokes that when somebody would come in looking for a $50,000 or $100,000 business loan, that they would scatter like cockroaches. They'd be like, "Oh yeah, the guy's not in. Come back later. Oh, I'm sorry. Can I take your name and number, and I'll have somebody get a hold of you?" And then they never follow up because in that environment, anything under $1 million is a waste of their time because it requires full documentation at those institutions. Full documentation at those institutions because they think you're coming to get a loan for a business. I'll share more in a moment about how it can be different. But they think that you're coming in to get a loan for your business. So they need to collect all the same documentation. They need to do all the same work for $50,000 as they would for $5 million. Same review of financials, same review of tax returns, same review of your application and all the accompanying documentation, right? So they don't want to lend to you. They don't want to lend to your business. They're not interested. It's a waste of their time and it's very low yield for them. And they were joking in this panel among themselves that they would all scatter if there was somebody coming in like you or me. "Hey, can I get $100,000? Now, $100,000 for you and I is a game changer. The number of properties we can take down, the number of notes we can invest in, that is an amazing step towards more success for us, right? But they're not interested in a $100,000 borrower. So the old paradigm makes you the owner of the note buying company or the buy and hold company, the fix and flip company, the franchise. In their world, in the manual underwriting world, you are the owner, and so they have to vet you and vet the business completely. Now, the problem that this brings up is that business owners are not fundable. Just straight up. When you walk in there and say, "Hey, I own a business and I want a loan," the first thing they're going to do is, "I want your taxes, I want your financials, I want to mortgage your firstborn child, and I want to know everything I can possibly know, and I'm going to secure it. And if you don't have something to secure it with, I'm not going to lend to you." Are you following me? They want to know all the facts, and then to belts and suspenders for them, they want to make sure you have something. "Yeah, we'll put up the equity in your home. Yeah, let's give you a HELOC as this business loan." I mean, it's ridiculous. Especially when you know the new paradigm. They want to secure that loan with your assets, right? So being the business owner is unfundable. Being the self-employed is unfundable. Now, we bring this on ourselves, you guys, until you started listening to the podcast, until you started checking out what fundability actually is. You believe you are what you do. I'm a real estate investor, right? Well, no, you're not. You are not a real estate investor. You're not a note investor. You're not a business owner. You're not a franchisee. And especially, you are not the deals that you do. What you are is an entrepreneur, and you've chosen a wealth strategy to achieve your goals, your dreams, your why. You are an employed professional, and an employed professional by your own organization, and we'll find out what the fundable organization is right now. But if you're an employed professional by a fundable organization, you now you will make the day of these lenders, because now you fit into a completely different class than the ones they hate working with. Unless you want $5 to $10 million and you have the assets to back it up, they don't want to talk to you. But if you are an employed professional representing a fundable business that fits automatic underwriting guidelines, they are all over you. And to remind you, listen to what I just said. If you are an employed professional of a fundable business, they want to work with you, because every loan approval for small business, entrepreneurial small business loans, 80% of that decision is based on your personal profile. As the principal of the organization, as the employed professional, they're going to approve or deny you based on how good your personal profile is. Then they're going to look to see if the entity is fundable. And by fundable is it a legitimate entity that matches the data points so that the principal and the business are congruent. I'll show you what that means in a moment. To further what David said, you have to optimize the principal's profile for business credit approvals. You've got to do things to the personal profile that's going to pass muster, that's going to in automatic underwriting software. So let's take a look at what that actually means. So the old paradigm is we want to get away from you being the owner of all these different enterprises. We're going to call those client companies, right? All those companies, everything that you're doing, you could have one, you could have 10, but all of those, if you say you're the owner, we're already dead in the water. We're going to go down the old paradigm route of full doc required and a whole grip of hassle to secure it with your assets. And if you don't have the assets, they're not going to lend to you. What the lenders want, because 80%, guys, of the lending decision is based on the principal's personal profile. That's a mouthful. The principal's personal profile. Lenders love to lend to the genius behind the business. They want to lend to the strategist behind the business, the person who knows how to make good decisions, the employed professional. So let's talk about what the most fundable strategy is. Let's take a look. So if you're watching, I'm going to describe it all out for those of you who are listening, but for those of you who are watching, all of those entities down at the bottom are we call client companies. Remember, you have a note buying entity, buy and hold, fix and flip, franchise, private lending, even the next opportunity, cold fusion storage, if you will. But each one of those, a qualified fundable entity has to be what we call a bank-facing entity. It's got to be transparent. It's got to have viable ownership, and there are criteria to that. There are other. Come to the boot camp if you want the deep dive of this. This is the podcast, right? This is skipping a stone across an 800-foot lake. But I'm trying to give you as much information so that you know. If you haven't been to the boot camp, come to the boot camp. So that's getfundablebootcamp.com. It'll be in the show notes. Getfundablebootcamp.com. Show you how to set one of these up. All right. The bank-facing entity means that they're not lending to the bank. They're lending to. They're not lending to the entity, what we call a QFE, qualified fundable entity. They're not lending to the entity. They're lending to you behind the entity. You're the 80% worth decision making, right? They want to lend to the principal. So it has to be a bank-facing entity. Now, this entity can't own other entities. No wholly owned subsidiaries, can't be a holding company. It can't be owned by any other entities, and it can't own any other entities. So think of it as literally, if down here is your asset protection and all holding companies and trusts and land trusts and LLCs to hold your properties, if all of this is your asset protection org chart, way up here all by itself is your fundable entity. Okay, then it can't have any deal-killing assets, meaning this entity, if someone were to ask for your books, we don't want to see a whole bunch of we don't want to see a whole bunch of assets. We don't want to see a whole bunch of properties or rentals or loan notes, because they're going to say, okay, great. They're going to go straight from automatic underwriting to manual underwriting, and they're going to want to use those as security. We don't want that. We want to stay in the lane that is automatic underwriting, right? So no deal killing assets, and it has to have legitimate income. Now, what do I mean by legitimate income? Well, think if you've got a notes company, right? Then you got notes that are paying points, interest, monthly payments on the mortgage or otherwise. But a lender in automatic underwriting isn't going to count your mortgage payments as legitimate income. They won't do it because it's not stable, right? What happens if those guys stop paying? What happens if your notes come due and they're not paying on them? Lenders in automatic underwriting, which is the cherry on top of all approvals, they're going to go, oh, you got points and interest. Let's do full doc. And now you start to see why they don't want to work. If you're asking for $100,000 from one bank, then they don't want to go through all of this mess of evaluating your mortgage notes and longevity. And same thing on rents. They're not going to take rents as legitimate income. They won't count it because they won't count it in automatic underwriting mode. But if you switch lanes, go to manual, then they'll be like, you guys have heard it. All right, let's take 85% of occupancy for 75% of the year, and we'll count that towards the income. And let's say you're bringing in $2,000 or $3,000, $5,000 in income, and you only get to claim on as income in this for this loan of $2,500 bucks. That's ludicrous, right? Fix and flips. Yeah, try and tell a lender that you would like $100,000 so that you can flip a house and make $10,000 to $30,000 or $40,000. They'll be like, yeah, I want a note on that house, and they're going to try and secure it. Are you guys seeing what I'm doing here? There are two lanes: automatic underwriting, the sweet spot of funding, and then manual underwriting. And they don't want to work with you in manual because they're doing all of this book work to find out to give you $50,000 to $100,000. They don't want to do it. And you don't want to work that hard. You don't want to work that hard trying to get $100,000, right? I mean, so profits from your franchise. If you have a notes business, yeah, they don't want to lend to you if you're counting interest rate on not mortgage notes this time, but where you're doing personal loans, right? Where you're fronting capital for, let's say, real estate investors or other business owners. So you guys, that's what we call that's not legitimate income for a lender who's looking. It's legitimate income at some significantly discounted amount for manual underwriting, but automatic underwriting, they're not going to count any of that because they want proof. They want a stable, because that's a business owner trying to prove up. They want an employed professional that they can just look at the profile, look at the business, and give you money. So let's look at how we can create that. Next, so we said, let's call all of these guys, let's call every one of those types of businesses your client. Well, if they're your client, what does that make you? Well, let's split up this process, the QFE. You're the strategist. You went to real estate school. You went to, got the education to become a note buyer. You are the strategist. You're the decision maker. You're the genius behind these deals. The deals are happening down in your clients. Am I making sense? Your client companies, that note company, the buy and hold, the fix and flip company, that's where you execute your strategies. So let's separate those. Let's put the strategist, let's put you in the QFE, the qualified fundable entity, and separate that from your clients, those client companies. Now, how do we do that? Because you say, hold it, but I own the fix and flip company. I own the buy and hold company. I own the franchise. Well, in 2010, it was originally associated with elections, but it's had far and wide sweeping effects for in a number of industries, including this one. In 2010, the Supreme Court ruled that entities are people too. Meaning that the owner of the entity and the entity itself are not the same person by legal definition. So that who you are is separate and distinct from who the business is. Supreme Court ruling. And so, and I'm not the, I'll show you, I'll share with you an example of somebody who just killed it with this strategy. But so your client companies, even though you are the owner, the shareholder, the sole member, whatever, those client companies are separate from the strategist in the QFE. And if you're looking at watching the video, what's in that box, the QFE, that is the strategy level. All the clients are down below. So we're just separating you from your entities as per the Supreme Court. Thank you very much, ladies and gentlemen. So now that you are separate, you get to treat those client companies separate from you, even if you are technically the shareholder or the member of that LLC. Now, so what do we do this? We convert non-usable profits into usable revenue for the QFE, the qualified fundable entity, by making you the strategist, the consultant, the management or the advisor to all of those client companies, because you are separate from those client companies, guys. Straight up separate. Don't get it confused that I own these client companies, the fix and flip and the buy and hold and the franchise. It doesn't matter that you own them. They are separate from the strategist. And that strategist, you're the one making the decisions for every one of your income streams. You're the one doing that. So all we're doing is making the QFE, the qualified fundable entity, we're just making the QFE embody your strategy and calling it a consulting firm, a management firm, an advisory group. Okay? The second we do that, those profits that have to be that income from your notes business, your buy and hold, your rentals, your fix and flips, your franchise, all of those, we automatically convert those from, because if you put those down on an application, they want to see them. But if you convert that, and those are client fee, each one of those clients start paying consulting fees, management fees. Now, I'm not talking about property management. I'm talking about strategy. You are a strategist. If they start paying you fees, then Bank of America, Wells, Chase, all the tier 1, tier 2 banks, everybody who's in the business lending business love this model because they don't have to do all the BS of vetting all of your deals. Your clients, you are billing your clients for consulting fees, for management fee, marketing fees, advisory fees, right? You can sit on a board and get a board of director fee, but you are the strategist up above and they are clients below. And every time they pay you a fee, then your income is massively legitimate to lenders. Plus, since there are no assets, you're literally an income and an expense type of business. Everything that you're doing, guys, translates from ugly money, dirty money, right? Points and fees and profits from flips and rents. All of that turns into clients paying, your client companies are paying you management and consulting fees for your genius. Lenders, man, I'm telling you, lenders will lend to that perfect model. And they will do it without requiring income verification. These are stated income because there are other things that we've talked about, running traffic patterns in the business accounts, et cetera. But guys, this model shows that you are a fundable employed professional, that you are personally fundable, and that your business model is one where you are the strategist, the genius that's being paid. You're being paid by other companies. It doesn't matter who owns them, including yourself. You're being paid by other companies for your genius, and lenders love to lend to that. So you are not your deals. You are not your businesses. Lenders are willing to fund you. They do not want to fund your business at all. So that is that is kind of the long and short of it, is that we got to know what's business credit, what's not business credit. We've talked about that in previous episodes. But you guys, while I've covered in a much more clear way from a year and a half ago when I covered this before, you are fundable the second you have a fundable personal profile, and your entity is fundable when you separate it, the strategist level from the client level. And then the clients bring in their revenues from wherever they get them and pay you, the strategist, management, consulting, and marketing fees. Whew. Pretty cool, right? If you want to figure out how this applies to your particular thing, as I said earlier, go to getfundablepbootcamp.com, and it's a 2-day dive into personal and business fundability. All I know, guys, all I know. And when it comes to fundability, that's quite a bit. And what we need to understand is if we know how the rules of this game, what the rules of the game are, we can play it, not just win it, we can master it. And that is my hope for you and your loved ones, is that you take whatever you're learning, and let's continue to walk with me down this fundability path, and get a copy of the book, getfundablebook.com. It's free. I'll get you a copy of the book. You just cover shipping. Just tell me where to send it. Just keep walking down this path. That's what I would implore. And in the middle of, coming out of whatever we're doing with the pandemics and recessions that look like they're teetering on the edge of crushing us, we have no idea what's happening. What I do know is lenders only make money when they lend, and their favorite way to lend is to unsecured, stated income, automatic underwriting, because they trust their software to make positive decisions. If you put yourself in that flow, if you make your business fundable, a QFE, qualified fundable entity, if you make your personal profile fundable, guys, our clients are still getting our clients are still getting right now, 6 months into COVID, 7 months into COVID, and we're averaging 2 to 3 million in fundings every month. We're at 12 million for this period. Come and get your slice of the pie. This is Merrill Chandler, your host of the Get Fundable podcast, and let's keep going, guys. I'll see you next time.
Thank you for listening to the Get Fundable podcast. Please leave comments because Merrill would love to read about your aha moments from this episode. And be sure to visit getfundable.com to read our blog, get important links, join our community, and much, much more, like ordering Merrill's tell-all book that is changing the world, The New F Word. And you got to tell your friends about this podcast because we want them to get fundable too.